And welcome to everybody. This is the Earth Equity first quarter 2024 webinar. I'm Pete Kroll, if you don't know me. I am partner and Director of Sustainable Investing for Earth Equity, which is a prime capital investment advisors company. So thank you for having everybody for being here today. And let's go right ahead and jump into the presentation here. So give me 1 second. We'll get the screen shared. There we go. Of course, we have to give you the disclaimers as normal. So our agenda is pretty much the same thing every time we host one of these, but I'll go over it real quickly here. We'll do an Earth Equity update. We'll talk a little bit about markets, economic update, et cetera, and focus a little bit on inflation, interest rates, what the markets have done over the past quarter. We'll talk a little bit about portfolio construction, how things look right now in our Earth Equity portfolios, and we'll give you a chance for Q&A at the end of the webinar. So we're going to start out by saying something that's really bittersweet, if you will. We are preparing for Lisa's retirement on April 30th, so she has 2 weeks as of today to be with us. She has been in financial services for 44 years. She was a pioneer in women working in banking. She had senior roles with both Citigroup and Bank of America. And we were really lucky that when she was looking to team up with a firm, she found us and we found her. And she, I believe, had said that she would never work for another firm that wasn't a certified B Corp. And at the time, we certainly were. And so she's been with us for almost 10 years. We are absolutely all going to miss her, especially her enthusiasm and the way that she treated clients and how important and how she sort of made her life a big part of making sure that her clients were taken care of. Those clients are going to continue to be taken care of. Neil and Carrie will be helping with all those folks, but of course everybody's going to miss Lisa, and so I really want to say to her, thank you. We do have some room left at the retirement party on May 2nd here in Asheville. So if you would like to come and join us, please let us know. We would love to have you. And like I was about to say, thank you, Lisa, for the time that you have spent with us. You are a vital part of our team, and we are going to miss you dearly. Quickly, Earth Equity update in terms of integrating systems with Prime. We are pretty much done with just about everything. We have a couple of boxes to check when it comes to fidelity and cost basis. We're continuing to work on that. We still don't quite have a fully accurate performance history in Orion, but it still is a better way for you to access your accounts. So if you haven't been accessing your accounts through login.orionadvisor.com, talk to your advisor or talk to Rebecca, and they will help you get signed up for that. As pretty much every quarter, we have been in the news in a number of different media outlets, from financial planning to Reuters, Bloomberg, et cetera. I wrote a piece locally here in Mountain Express about how HCA has taken over our local hospital system here and not done some very good things with it. And so we've seen some negative outcomes from that corporate takeover of our hospital system here. Dollars and Change, the Expert's Guide to Sustainable and Responsible Investing, our podcast. We are on, I think, episode 5 right now that we've released. Of course, if you haven't watched episode 1, which is my favorite, with actor and environmental advocate Ed Begley Jr., please make sure that you watch that. It's a lot of fun. He's a great guy, and I was really lucky to get to spend some time with him back in September at his home in LA. But we have a brand new one that just came up, I think, about a week ago with George Gay. George has been a sustainable investing stalwart for the last probably 30 plus years. He is CEO of First Affirmative Financial Network, which is another sustainable investing firm. Super guy, good friend. And when I was in Denver in October of last year, we recorded this episode. So check that out as well. We always take a look at headlines, and so we've got a good mix here. Inflation has been on everybody's mind because we haven't seen exactly the downward trend, which is not surprising, of course. But that came in, like it says here, a little hotter than expected in March. I don't think it's as big a deal as some people say it is. Something I've been talking about for years: climate change is fueling the U.S. insurance problem. That's a no-brainer. Excuse me. A bunch of different things here that we're keeping an eye on. So in terms of markets, let's take a look and see how the markets did the last quarter. So S&P 500 was up about 10.5%. On the opposite side of that, clean energy was down about 10.4. Clean energy, for the most part, since 2020 has not performed, partly because we've seen a shift from growth to value investing over that time, but we probably back in 2020 were a little overvalued. And so, that's one area that obviously is really important to us and that we keep a very close eye on. If we go out for the trailing 1 year, we see the S&P is still leading across the board, which is not unusual. We'll talk about this in a second. But you have companies in there like NVIDIA and Apple and Microsoft that have really done exceptionally well, and they have an outsized impact on the returns. If you look at other indices like the All Cap World Index, which is the red, down or up 22% over that time, it's a little bit more moderated because you've got more stocks in that index. You have got stocks that are across the globe and also small, mid, and large size. So the S&P 500 are the largest 500 stocks in the U.S., and it's weighted by the size of the company. So you can have some very big influence if you're one of the bigger companies there. When we go out to the 5-year number here, or the 5-year returns, S&P continues to outperform again. We have to take that with a bit of a grain of salt. But this is where we see clean energy comes back over the longer term. And a lot of that is, of course, because where we went from back in 2019. Obviously you can see where the peak in the purple is there back at the end of 2020, beginning of 2021, and then pretty much settling out since then. So we have a poll here. Let me get the right part. There we go. Where are my polls here? There we go. All right, we're going to launch the first poll here. So what is your opinion of the economy currently? So is it excellent, good, okay, bad, or horrible? What do you guys think? We've got 20 folks that are on the line right now. I'm really curious to see what everybody thinks. All right, 15 to 20 of you have voted. Anybody else want to get in here real quick? All right. So the majority of you, about 56%, think that the economy is good. 38% of you are neutral on it. You think it's okay. And one of you does not like it. You think it's bad. I tend to think we're in the okay to good category. There are a lot of external risks that we're looking at right now, from monetary policy to geopolitics, wars, things like that. So thank you for your input on that. Let's talk a little bit about inflation. It does continue to be a bit of a thorn in the Fed's side, although I don't think at 3.5% that it's certainly as onerous as we saw a year ago. I looked at the last webinar that we did about 3 months ago, and it pretty much was split about 50-50, I think is what I had in that, whether economists thought that we would have a recession in 2024. Then again, I saw this headline that came up this week. Remember the predicted 2024 recession? Well, economists don't remember it. They're instead raised their growth forecast by almost 70% for the year. I think that that might be a little overly aggressive, but at the same time, I also don't think we're going to see a recession this year unless we see, again, some of these extenuating circumstances that aren't directly a result of the economy thing. Again, geopolitical issues are probably are the biggest risk to what happens when it comes to a recession. You know, and interest rates continue to be high. We don't really have a whole lot of visibility from the Fed as to when rates will start to come back down again. But I really do continue to look at higher interest rates as an opportunity to both lock in some yield, which we haven't had since, you know, forever, and to maybe get some capital gains as interest rates move back down. So, you know, it's taking longer than we had anticipated for yields to drop, but honestly, it's not, again, it's not a big deal. It's something that we really want to take advantage of. And we'll talk about a little bit more about that in a bit. So the valuation in the S&P 500 moved up again over last quarter. We can see that we're now, you know, one standard deviation above where the average is. The average PE is about 16.5. Right now we're about 21. So, you know, markets probably are a little overvalued right now. You know, but I mentioned this earlier when we were talking about performance. The top 10 stocks continue to have an overweighted influence. So the top 10 companies in the S&P 500 make up a third of the valuation. So when we think about this, there's 490 other companies that make up 2/3 of it, while only 10 make up 33%. And again, those companies, I'll show you that list in just a second here. But you know, those companies make up a quarter of the earnings of the S&P 500. So they are companies that are, you know, contributing a considerable amount in terms of earnings. But again, it's only 10 companies. So they are Microsoft, Apple, companies that you've seen before. A couple new ones in this list over the last quarter is Eli Lilly and Broadcom have really have come in, which we haven't seen them, as far as I know, in the top 10 in the S&P in the past. But we have seen Alphabet, which is Google, Berkshire Hathaway, Facebook, etc. Inflation, again, has dropped considerably over last year, but it does continue to be a bit above what the Fed would like to see it at. But I mean, when we look at this chart, you know, and we see, you know, where we were and where we've come and how fast that took, especially when you go back to the 70s and early 80s, and you know, the type of inflation we saw back then. You know, we're really lucky in that we haven't had to deal with this for an extended period of time. And we can see here when we look at this chart that goes back to 2010 that you know, we're back to a better level. We're at about 3.2% here in the U.S. We kicked up to 3.5 in March, which for some people was a surprise. You know, but other areas like Eurozone, for example, Germany is in the twos. You know, Japan 2.8%. Even emerging markets, you know, China barely has any at this point. Of course, if you can, you know, take their numbers with a bit of a grain of salt as well. You know, we've seen the inflation come down and then just sort of level out towards, you know, September, October of last year. And that's okay. You know, the biggest component in the headline CPI, of course, is shelter. I want to focus a little bit on one part of this, though. When we look at, when we take shelter out and we take a look at inflation in general, there's one area that really seems to stick out here, and it's in the red, and you can see it's auto insurance. And I don't know if anybody else is feeling the pinch from this, but I certainly noticed probably mid last year that our car insurance bills started to go up. And it's on people's mind. I saw a headline about it the other day. I'm like, well, I'm going to take a look into this and see. But auto insurance is up over 22% in the last year. So that is well above any of the inflation numbers. It's the largest jump that we've seen since the 70s. And since 2020, it's up 38%. So insurance has really, or at least car insurance or auto insurance has really skyrocketed over that time. And I'm sure we're all feeling a little bit of that pinch. You know, why is it happening? You know, things that are not really a surprise, things like distracted driving and speeding, one of the things that this article talked about was moving from mechanical, heating and air conditioning to buttons on basically an iPad. My Tesla has basically an iPad in the middle of the car, and if you want to do anything, you have to go to that, which is going to take your attention away. So that's led to more serious accidents, especially the speeding part of it. I think people got used to driving fast during the pandemic when there weren't as many cars on the road, and now you got a lot more cars on the road. We've also seen fewer cops patrolling on the on the traffic side. Again, this is all info from Vox, but we certainly see that here in Asheville. And of course, cars are a lot more advanced than they used to be. And so they're a heck of a lot more expensive to fix because they're basically computers on wheels at this point. So a little bit more on inflation. When we take a look at delivery times index, we go back to 2021 when we were really in a pickle, if you will, with trying to get supply chains on any kind of a schedule. Now we've seen back in February that bottomed out, but that the delivery times have come up a little bit. Some of that has to do with the war going on in the Middle East and ships having trouble going through the Suez Canal. They may be going around the Horn of Africa. They may be going in different directions. And so we've seen that come up just a little bit. That may have contributed a little bit to inflation. This is something that I think is really interesting. And there's been a couple of commentators that have talked about things like shrinkflation and other criticisms of big business. Because when we look at this, we see that input and output prices. So the amount of money it costs to make a product and to put it out the door have gone down considerably. But I bet you if you look at your grocery bill, and if you look at other bills that that you've had for a long time, they probably haven't gone back down with this with the input and output prices. And so this is something that is an issue with global business and corporates who are making record profits because inflation really played into their profits and their earnings. This is just an interesting chart that I saw from JP Morgan. The role of China in imports to the U.S. we've seen gone down considerably over the past, what is that, about 8 years or so. And now the Euro area, which I probably wouldn't have guessed, is the largest percentage of goods imported into the U.S. Mexico is number 2, China number 3, and then Canada number 4. But you also see that Taiwan, South Korea, and Vietnam are rising fairly rapidly. Taiwan, of course, is home to Taiwan Semiconductor, which is where we get a ton of our semiconductors from. And of course, South Korea, we Kia, Hyundai, LG, companies like that are providing a bunch of different goods from washers and dryers to cars, different things like that is really picking up steadily. And I always love to throw in some random but charts that I think are important here. I love keeping an eye on real estate, but housing inventories, and this is always a lagging data at JP Morgan, but it's still showing historically low inventories of houses. What's good is that we're starting once again to see housing starts or new houses being built again. To maybe make up that difference for what is not available in inventory. But housing affordability still remains at lows that we haven't seen since the 80s. And a big part of that, of course, is interest rates. This will probably turn around maybe towards the end of the year, probably more likely at the beginning of next year, as interest rates come down and mortgage rates will likely come down with that. Household debt service ratio. This is an important aspect from an economic perspective to see, how extended are consumers. And, it's not, it's actually a relatively low number relative to going back to the 80s. And so this looks like a healthy number for us. But we are starting to see delinquencies go up a little bit, especially credit card and auto delinquencies. Student loans down, obviously, because there's been a lot of student loan forgiveness over the last couple of years here, but starting to see this uptick a little bit in delinquencies. Probably a little bit troubling, but nothing to be overly concerned of yet. We've seen, and this is just such an interesting chart because the blue is the savings that people accumulated during the pandemic because they weren't going out to eat, they weren't traveling, they weren't doing the things that they had been doing. And so we're starting, and we saw personal saving rates skyrocket over that time. But of course, once restrictions were lifted, once the vaccines came out, people started to spend again. And that's what's really been a big driver of our economy over that time. And so you can see we've gone into not negative personal savings rates, but considerably lower personal savings rates than we saw during the pandemic. And with that, we're seeing that excess savings start to drop. So we've gone from about $2.3 trillion in bank accounts back at the end of 21, beginning of 22, down to about just shy of a $1 trillion. Still a lot of money, but that is being paid down. This is something that I actually added to the not to the portfolio, to the presentation this morning. I saw an article that was talking about the U.S. dollar strength, and you can see the red line here is the strength of the U.S. dollar. This is just going back about 2 weeks, so this is going back to the beginning of April, and you can see that the U.S. dollar is up about 1.59%. You also can see that the S&P 500 is down about 3.6. This is something that I've noticed over the years is that when the dollar becomes stronger, a lot of times the stock market suffers some. And so this is something there's not really a whole heck of a lot we can do about this, but it's just something to give us a little reasoning for why, maybe why the markets have dropped over the last few weeks here. If we expand this out, going back, let's see, this goes back about a year, this goes back 1 year, you can sort of see that there is an inverse relationship between these two. When the dollar goes down, the market goes up, and when the dollar comes back up, the market goes down, and vice versa here. So it's an interesting way to look at things. Does it mean that if and when the dollar starts to go back down, we'll see markets go back up again? It's entirely possible, but of course you won't have as much spending power. So I guess at the end of the day, it really balances out. So let's talk about bonds. Excuse me, this is going to be a very similar discussion to what we talked about last quarter, just pushing it forward again. Carol, I see your raised hand. We will take Q&A at the end of the talk here, so hold on to your question or put it into the Q&A box. So right now, we've seen this mass raising of interest rates going back from basically zero up to the mid fives. JP Morgan and others think it's going to, settle back down, maybe not back to zero, which probably isn't where it should be, but into the mid twos, which makes a lot more sense to me. We maintain our model bond portfolio in our fund portfolios. It's about a 4-year maturity, so it's not super long, but it's not really short either. It's probably just shy of a sweet spot, which is around 7 years, where we are in this kind of a bond cycle. Yields, though, are fantastic right across the board, from treasuries into corporates. Investment grade corporates right now are paying about 5.3, at least they were at the end of March. They've come up some because the Fed has pushed out its schedule of lowering rates, so they're actually a little bit better than they were at the end of the quarter. And as I always, want to make sure you understand, so as interest rates go up, bond prices fall. And conversely, so when interest rates fall, which they will at some point, we'll see bond prices rise. And so we look at this as an opportunity. We continue to look at this as an opportunity. So when we look at just, let's say, for example, if a 10-year U.S. Treasury note, when interest rates rise, by 1%, then you probably are going to see a fall in the price of that bond by about 3.8. However, if we see a 1% fall in interest rates, which we probably will see, there can be as much as a 12% increase in prices of the bonds. So we have a serious opportunity for capital gains by making sure that we have good, smart bond portfolios for everybody, while at the same time making sure everybody has the right risk portfolio. So we're always looking to make sure that your ratio of bonds to stocks meets what your risk tolerance is. I used this quote from Steve Jobs last time because it introduces something that's important to us. But I really like what he had to say back in the day. Some people say give customers what they want. That was not his approach. He believed that their job was to figure out what they're going to want, what consumers want before they do. And I love this quote from Henry Ford. If I'd asked customers what they wanted, they would have told me a faster horse. They didn't know that they needed an automobile. So many times people don't know what they want until you show it to them. So our task is to read things that are not yet on the page. And I truly believe this, especially when it comes to the sustainable economy or the clean economy. And so, this is a report that came out from S&P within the last week or two, actually, here. It talked a little bit about the Inflation Reduction Act effects. Renewable energy credit market is going to grow at about a 10% annual rate from over the next 10 years, which means it's pretty much going to triple from 2022 levels. This is something that's really important. We look at what the clean energy economy has done over the last 3 years, 2.5 years. So basically since the end of 2021, has not done great. But at the same time, we have seen continued growth in the clean economy. There's a point at which that decline in those stocks is going to end. And this is one of those situations, and I've talked about this a lot of late. Everybody always talks about buy low and sell high, but when it is time to buy low, it's really hard to buy low. It's really hard to jump in and say, the solar company X is down 50%. Well, they're still the same company they were 50% up ago. So now might not be a bad time to add to that position. Doesn't mean that you're going to make money tomorrow. You might make money 2 years from now, but this is a long-term proposition, as you can see from this chart. Sustainable Brands did a study. Risk managers and consumers cited climate change as the top emerging concern. Surveys of risk professionals indicate intensifying concern about extreme weather as it more directly impacts people's lives and a corresponding interest in sustainable investment opportunities. This is what we've been saying for some time. Something that I've been saying for some time as well is that we're going to start to see more action on climate change when it starts to directly impact people's lives. And it's exactly what they said here. So when we look at the average temperatures, they continue to go up. Well, everybody, it was in Asheville, it was 80 degrees here yesterday in April. Probably isn't supposed to be 80 degrees here, but that's where we are. Looking at the top 5 emerging risks here from 2020 to 2023 based on the SOA research, which are actuaries. That's what I was looking for. The Society of Actuaries research. Climate change continues to be the top emerging risk. And when we look at ESG, so ESG, environmental social governance, we talk about that as a tool that we use when we talk about sustainable investing, when we use environmental, social, and governance metrics to help us get a better indication of a company. So Public-Private Strategies did a survey, and over half of adults support companies participating in ESG initiatives. Now, if you read the papers, if you read the media at all, I don't think people read papers as much anymore, the online papers, you would think that there's this mass group of people who completely oppose anything having to do with companies being what they call woke. But the reality is when you look at different surveys like this, and you see that 57% of adults are in support of companies transitioning to be more responsible, and only 17% oppose it. That sort of doesn't play into that into that narrative. And so that's why we continue to believe in the importance of sustainable investing. 3 in 5 adults have a favorable opinion of diversity and equity and inclusion um, initiatives. Actually, that's 63%. Same thing with socially responsible, corporate social responsibility, impact investing, et cetera. Just a really good broad base of support. 60% of adults are likely to purchase a good or service from a company that pays a living wage to all their employees. Again, we see 59% there, somewhat less likely or much less likely. Very, very small percentage of people would not shop at a place that actually pays their people well. There's been a lot of political talk about should we include ESG investments in things like retirement plans, et cetera. Almost 2/3 of people think that it should be easier for people to invest in sustainable and ESG investments. So let's go to poll number 2 here. I think maybe I might have figured out how to do this a little quicker. There we go. So poll number 2, we will launch. So are you optimistic or pessimistic for the rest of 2024? Go ahead and put your answers in here. All right. We've got about 77% of you. Anybody else want to? There we go. There's another one. So as you can see, we've got somebody who's very optimistic. We've got a couple people somewhat pessimistic, but most people are somewhat optimistic. And I tend to fall into that same category. I think it's hard to be very optimistic in a situation where we have in the Middle East and the situation we have in Ukraine. But I think we can be somewhat optimistic because there are a lot of good things that are happening. And so thank you, everybody, for sharing your thoughts on that as well. Let's move forward. There's my good friend Wayne Gretzky, and I will again say that I apologize that he's wearing an Oilers jersey because he should be wearing a Solar jersey, but that was not the case and probably won't be the case for now. Skate to where the puck is going, not to where it's been. This really sort of fills in on what we were just talking about where the economy is going, where the clean economy is going. And so, again, many of you have probably seen this before, but we'll go through it briefly. Our investment philosophy is just to make sure that we're investing in what the next economy is. So from alternative energy to energy efficiency, batteries, water, green transportation, natural and organic products and services, sustainable real estate, IT, green finance and insurance, the circular economy, something that we are starting to see more and more of, not just recycling, but actually creating products that are meant to be disassembled and then reused for either the same or a similar or even a completely different kind of product. That's an important part of our economy. Green building technologies, cutting edge biotech, something that we believe is important as well. When we look at our Green Sage sustainability portfolio, this is up to date as of the end of the quarter. It's broken down into just about every sector of the economy except for the fossil fuel sector, which we do not want to own in there because, as we like to say, we don't want to invest in dinosaurs and we would much rather invest going forward. So how are we handling the current market environment? So we continue to make sure we've got a good diversified group of equities from broken down by domicile, the U.S., developed and developing international. We break them down by size, large companies, mid companies, small companies. We also make sure that bonds are in or not every, but most portfolios. And we break them down by the quality, the duration, what their yield is, where they're located, and if they have a focus, and that focus might be climate or green bonds, things like that. And all of our fund portfolios have an allocation towards alternatives. Alternatives are non-correlated assets. So by non-correlated, that means that They don't move in the same cycles as the stock or bond markets, and those might be things from commodities to currencies and other derivatives. So our core balance, which is our biggest model, you can see over time that we've gone from about 50% in stocks. Right now, it's about 57%. But you can also see during the pandemic that we dropped down to about 30% at one point. So we do try to manage this as tactically as we can based on what's going on. Bonds were a very low allocation at one point, but we're starting to bring them back up. We'll probably move them back up once more, especially since the Fed hasn't started to lower rates. We'll probably take advantage of that over this and the next quarter. We've taken money from alternatives and put that money into bonds. You can see the correlation between those two there. And because we can get some good yield in bonds, we aren't using cash right now, but that is something, especially in a volatile market, that we do employ at times. Correlation, you can see, the darker the blue means the more correlated a fund is with one of the other funds. And we try to make sure that we've got as much that is either lighter blue or even has a negative correlation, like you can see with one of our alternatives here, just to give us a broad-based portfolio that's well diversified and has a bunch of different opportunities for gains when other things are going down. And so you can see this mix right here of equities, bonds, and alternatives of about 40, 30, 30 gives people a decent return, but with less volatility. You can compare that to, say, the 60-40 portfolio, which is just to its right. You don't get as good a return and you get more volatility. So adding that in actually makes a difference. So that's important to us as fiduciaries when we put portfolios together, that they're as stable as we can possibly make them. So in terms of the funds that we use in our portfolios, we did see good performance or excellent performance in the first quarter. Clean economy stocks continue their underperformance. Continuing to make sure, though, that we have an allocation in there is important. Can't tell you when that's going to turn, but it has to turn, or we feel like it has to turn at some point, but we can't tell you when. Long-term performance is in line with our expectations and the risk models that we've created. And as always, we will make tactical changes mid-cycle if we think it's warranted, but we haven't done that really since the pandemic. So when we go through and look, the orange are different indexes that we use. So All Cap World Index is one that is pretty much, again, I talked about this earlier, all companies across the world, all different sizes. So I think when you look at it when you really are trying to look at what markets are like globally, that's probably your best indicator right there. S&P 500, large companies based in the US, Russell 2000, small companies based in the US. EFA, EAFE are developed like Europe and Japan. Emerging markets is China, Southeast Asia, other smaller markets like that. And we're really proud that when we look through some of the funds that we specifically use, especially with a bigger allocation like Brown Advisory Sustainable Growth, it has consistently beat its benchmarks, going back for quite a ways. We see that also with small cap as well here. We see that with international as well. We see that with emerging markets, et cetera. Wasn't going to click there, but you had a chance to take a look at that. We'll move on to bond and alt fund performance. U.S. aggregate bond is basically a scale of or an index of bonds across the U.S. Typically, it is going to be investment grade. And so when we look at how we've performed, we can see our different bond funds have all outperformed pretty much across the board here. And so we're really happy with that. One of the funds that we have used, unfortunately, is being closed, so we're not going to be able to use that in the future. But I like what we've got here. The hedge fund index that we were measuring against last quarter is no longer there, so I don't have an index for you on this. But to just give you just a quick example, these are the three funds that we use that are alternatives. You can see that they all have really decent returns, 5 years, 969. AQRs has not been around as long, but they've performed obviously exceptionally well. And Camel's been around for a very long time, and they've got a good long-term record as well. Obviously, past performance is not indicative of future results, as we all know, but we want to make sure that we try to get you the best that we possibly can, and also the most responsible at the same time. Those are two really important factors for us. When we look at asset class returns, we can see that, in 2023, large companies in the US were up the most. Developing markets, equity, so again, Europe, Japan, et cetera, next, small caps, et cetera. And an asset allocation, which is about a 60-40 mix. This doesn't include, this does not include alternatives. But you can see last year was up about 14. Asset allocation year to date, so the first quarter up about 4.2, which is about where we would hope them to be. Importance of investing long term. I love to show this. I show this every quarter, but it's important to remember that markets can swing really widely in any 1 year period. Same thing with any 5-year rolling period. But the farther out you get, from a 5-year, 10-year, 20-year perspective, if you're a long-term investor, you almost always make money. Again, nothing's guaranteed, but based on looking at numbers over since 1950, on any 20-year rolling period, you haven't lost money. So look at things from a long-term perspective. I've talked about this a lot lately, especially on a couple podcasts that I've hosted, about how we've transitioned from investing in businesses long term to really focusing on what I call short-term speculation. When I started in this business back in the late 90s, when CNBC and the internet and a lot of these technologies were just starting to reach adoption or mass adoption, you didn't have the kind of immediate data that we have now. And I think, there's really definitely some positives about that, but I also think there's some negatives because we focus a lot more on, what's the 1-year return on something instead of, are they investing in a business and are they investing in that business to make it durable for the long term? And I think that we're a little bit misguided in that we aren't spending enough time focusing on what the long-term implications, both from investment and from climate change and so many other issues are. Timing the market, I love this chart. If this goes from January 3rd through December of 2022, if you put $10,000 in and just kept it the whole time, you had just shy of 65,000. But if you missed the 10 best days in the market, you halved your return. You missed the top 20, you almost halved your return again. Missed the top 30 days, you're still positive, but you only made $1,700 over that 20-year period. Missed the top 40 days, you're in the negative. So it's amazing when you look at numbers like this, trying to time the market, even though we will strategically make moves, we will rarely pull out of a market entirely. This is the reason why. So in summary, as always, we're going to continue to keep a close eye on the economy. I didn't really talk about geopolitics, mostly because there's really not a whole lot that I can add or talk to about it, other than it's a risk, it's a systemic risk, and we will make changes if necessary based on what's going on with those. Right now, we don't think that there's anything that we can do that will either get us alpha or get us a better return, or will cushion us against any volatility. So that's just something that we're going to continue to keep an eye on. We will make tactical changes if and when it's warranted. We are grateful for your business, your friendships and introductions. One of the biggest ways that we've grown our business over the years is with clients that we currently have that have come and said, "Hey, talk to my brother, talk to my neighbor, talk to somebody else who's really interested in sustainable investing or just investing in general and want to invest for the future, invest in growing into the clean economy." So we are grateful for that. Please keep those introductions coming. We are always grateful for that. There's one thing I wanted to mention here right at the end. This is the first webinar that we're hosting that a client that I had for, gosh, probably 16, 17 years. This is the first one he's missing because he passed of cancer within the last month or two. And so, there's something important about the connection that we have with people, the connection that we have with clients. And, I realized that this morning that he wasn't going to be on the call. And it's sad for me. I know his widow is doing well, but we are grateful for every one of you. So we want to see you on these webinars and working with us and meeting with us. We hope that we see a bunch of you at Lisa's retirement party on May 2nd. And with that, let's go to some Q&A. I will leave our disclaimers up here for a second. How big is the first question, how big is the sustainable investing market in dollars? What is Earth Equity's total client assets at this point? Sustainable investing market is really tough to gauge. So US SIF, which is the Sustainable Investment Forum, has come out with numbers over the years. One of the numbers they came out with was I want to say $1.7 trillion. They went back and looked at that and said, and recalculated things, because I think there was some double counting and some other stuff. It's probably, and this is a pure guess, so please take this with a grain of salt. It's in the $1 trillion area. We managed just shy of 200 million at Earth Equity, and growing rapidly, especially since we teamed up with Prime Capital Investment Advisors. We now have almost 200 reps across the country who have access to our portfolios. And very soon, we're also going to have a product that's going to be available in retirement plans, which that's one area that there's a definite lack of. So, think about this for a second. So retirement plans, just about everybody's got a 401k at this point. The statistics from Morgan Stanley show that 96% of millennials have an interest in sustainable investing. 91% of Gen Xers do, and 85% of Gen Z have an interest in sustainable investing. Yet very, very few 401k plans actually have a sustainable investment option. And so it's having a sustainable investment option is really important to us. It's important to Prime Capital, and that's something that we're going to have very, very shortly as well. So I just had a call about it yesterday. My hope is I can't give a number, but hopefully very, very soon. How do we get notices on any changes in portfolio allocations? We typically don't send out a particular notification on that. So we typically will rebalance the fund portfolios every quarter. We left things how they are this particular quarter because we didn't have any need to change them. But you will typically see some changes, and it's not made massive changes. It'll typically be 1% this way, 2% that way with the funds that you currently have. If you've got the Green Sage Sustainability portfolio, that gets updated every 6 months, as does our decarb portfolio. Green Sage gets updated in June and December every year, and decarb gets updated July and January. Those we will typically send out we just started using a sheet that lists all the different stocks in there, and we've got copies of those. But all those, it has links to every single one of the sustainability pages for each of those companies. So it's a really informative sheet. Alice asked about 529 sustainability options. 529s are odd vehicles. And the reason they're odd vehicles is because they typically are administered through individual states. I can't give you an answer on that, but please reach out to us outside of the webinar here, and we'll get back to you on what we know about 529s and sustainable 529s. It makes sense to me that we would want to have that because if you're going to be sending your kids and grandkids off to college, I certainly wouldn't want to be doing it on oil money. So how can we access the sheet you mentioned? We've been or haven't received updates. Okay. I would reach out specifically to your advisor. And this particular webinar will be shared over the next week or so on YouTube. So you'll be able to go back to that as well. Anybody else have any other questions? We've got a couple minutes here. I apologize for my dry voice here. Well, if nobody else has anything, I want to thank everybody for their participation. We're grateful, like I said, for everybody's business. If you need anything from us, please reach out to your advisor, reach out to Rebecca, and we will see you next quarter. Thanks and have a great day.